Good afternoon, everybody. Welcome to this month's live market update. My name is John Pasalis, president at Realosophy. And like every month, just going to unpack some of the latest trends I've been seeing on the ground in the housing market. I actually haven't been as active the past little while on Twitter, so I haven't kind of updated with some of the things I'm seeing, but we'll unpack some of those things today for anyone who's keeping an eye on the market and wants to kind of keep on top of some of the latest trends. So let me pull up my today we're going to unpack what's going on in sort of the market. We're going to kind of talk about houses versus condos and some of the first signs we're seeing, at least I'm seeing, of the market starting to slow down a little bit. And I'm going to chat a little bit about that. And of course, as always, actually, I should say we're going to chat a little bit about sort of Canada's housing affordability crisis. There's a great report from BMO that I highly recommend. I'm just going to kind of touch on very briefly here, but we'll add the link to it in the show notes and in the description. And as always, we have Mr. David Larocque, mortgage broker, who's going to be unpacking some of the latest trends. I mean, and quite frankly, he should have been the headliner today because it was crazy past couple of weeks in the mortgage market. Bank of Canada raised rates, and that's having some side effects. I mean, normally we wouldn't expect a quarter basis point increase to have such a big impact, but I think it is and will. I'm curious to hear what David thinks, obviously, as well, and get his feedback and have him unpack some of the things that he's seeing in the mortgage market. As always, Urmi's on the line as well. Just keeping an eye on comments, questions, post them. Anyone who wants or has any more specific questions, you can set up a consult at movesmartly.com/meetjohn. But otherwise, please post your comments in the chat. Urmi will be keeping an eye on them, and we'll kind of be hitting pause periodically to go over any of your specific questions about the market, about rates, about anything that we're chatting about today. Also, I launched a webinar this month called the Top 10 Home Buying Strategies that Give You an Edge in the Market. You can find it on movesmartly.com/webinars. We'll post a link in the show as well here. But really, it is, it's a 1 hour kind of crash course, if you want to think about it, about some of the things I think buyers don't understand or don't think about when they're navigating the market, and things that I think will give them a bit of a competitive edge. Especially in a market like Toronto that is pretty competitive. And of course, being competitive without, overpaying and setting the new sort of price level on homes. So there's this balance between, being, offering a reasonable price, kind of not overpaying, but still giving yourself an edge in what is a competitive market. And that's some of the stuff I'm going to be talking about in the webinar. So you can find that movesmartly.com/webinars, and we'll have that in our show notes as well. So just quickly going to unpack some of the latest trends for the market for houses. So I'm going to kick off just chatting a little bit about detached market and what we're seeing on the ground. We saw about 4,000 detached homes sell in May, and that is below the 20-year average. I mean, typically we would see around 4,700 homes. So we're below the 20-year average. So not the strongest market, of course. It's, and we're well below, I'd say. There's only a couple of years recently that were below. Obviously, 2020 during the peak of the lockdowns. Last year, sales were actually lower, and that was because the market turned, and similarly in 2018. But, if we look at historical trends, we're well below that. And then when we look at the number of new listings coming on the market for sale, again, this is where we're also seeing, some of the challenges in the market. There were just about 7,200 new listings for detached homes. Typically, there's around 9,000, and that's creating very tight conditions. When we look at the number of, number of detached homes that were actually available for sale at the end of the month, so the active listings, this is where we see kind of the biggest challenge in the market right now. There were 5,400 homes available for sale. That is the second lowest number of active listings for detached homes since 1996. And 50% below the typical average. So typically we'd have about 10,000 detached homes for sales. Last month it was just over 5,000. And when we think about what's creating the price pressure that we've seen since the start of the year, it is this tight inventory we're seeing, rather than last year or a year and a half ago, it was like this unbelievably strong demand. Right now it's balanced demand, but very few listings available for sale, and that's keeping the market kind of tight. And when we think about how tight the market is, as we talk about on here, it's usually the balance between sales and inventory. So this metric we call the months of inventory. So, if there are 10 homes available for sale and 5 homes sold that month, we would have 2 months of inventory. So the higher the months of inventory, the slower the market; the lower the months of inventory, the more competitive the market. And houses is right around 1.3 months of inventory. It ticked up a little bit, but still very kind of tight seller's market. And when we look at prices is kind of where we're seeing some quite a bit of growth. I mean, prices ended the month I'm going to low-rise homes in total with semis and row houses. So all low-rise home average price is 1.473. That's up 2% over last year, and up close to 200,000 since the start of the year. So again, a very interesting dynamic, not something most people in the industry expected. I mean, normally when you have rates explode to where they were, and so much pressure on affordability, we wouldn't expect prices to increase. And this obviously challenges this assumption that the price growth in the market is entirely about low interest rates. Well, I mean, it's not always about low interest rates, clearly, because right now we have very high interest rates and prices are booming. So that is some of the price trends we've been seeing on the low-rise market, and certainly a lot of pressure on price growth and affordability on the low-rise market. But I'm starting to see signs, quite frankly, of that stabilizing. I'll chat a little bit about that in the next coming slides. Now, when we go to the condo market, condos are showing a slightly different trend. There were about 4,400 condo sales in May of last month, 2023, and that's above the 20-year average. So sales are relatively strong for condominiums. When we look at the number of new listings are also pretty decent. I mean, we're just over 4,200-ish or so listings. Again, that new listings are a little bit below the long-term average. We would typically see closer to 5,000. So inventory or listings are a little bit tight. But when we look at the active listings, we are about 4,200 active listings, 5,400 is typical. And again, we've seen this big decline in active listings for condos since 2016. So the market is definitely still pretty tight for the condo market. When we look at the months of inventory, we're at about 1.6, so it's still a tight seller's market. And prices have been trending up even for condominiums. I mean, last month average prices were 778, down 2% over last year, but still starting to trend up a little bit. Now, I think I mentioned earlier that starting to see the first signs of the market kind of cooling down. And one way you can see this is if we track months of inventory, which I talked about as a metric. It shows you the balance of the market. It kind of gives you some clues into where things are going. If you look at it weekly, and again, you cannot put too much emphasis on what's happening from one week to the next, but we're looking for, a shift in the patterns, right? And if we look at months of inventory on a weekly basis, we see that, since the end of May-ish, or mid-May, we're starting to see them trend up. And again, we're still in a seller's market. It's still competitive, but we can kind of see that since the start of the year, the momentum for inventory was down. I mean, inventory has been plummeting since the start of the year. We can see that for most of this year, it was well below kind of the second half of last year. And we're starting to see that trend reverse. And on the ground, what we're seeing, at least what I'm seeing, is some leveling off in terms of the price appreciation for houses, especially. We're kind of seeing some plateauing a little bit right now. Again, the market's still competitive. So when people hear this, I'm not suggesting that, homes are sitting on the market for 3 months. Like the market's still competitive. There's still bidding wars. We're starting to see slightly fewer. So some bidding wars failing, and not getting as many offers and as many showings, and prices stabilizing. So again, this is some of the first trends. And what happens for months of inventory to pick up, really what this means is the sort of new listings are kind of outpacing the sales, which is why we have inventory levels gradually starts to build up. And, again, I think this is a side effect of a few things. Potentially the rate hikes, I think, is going to contribute to this. And we'll chat about that with Dave shortly. But also this is a seasonal trend. We typically see the market slow down as we move into the summer. So it's going to be hard to differentiate what the key driver is, but we're starting to see a little bit of a slight cooling down in the market. Now, before I bring on Dave, I just want to kind of touch on what I thought was a great report this month published by Bank of Montreal's economists, Douglas Porter and Robert Kapchik, and the headlines, Catch-23, Canada's affordability conundrum. I thought it was a fantastic report that unpacked some of the challenges. And I'm going to read a few excerpts quickly just because I think they did a very good job of kind of unpacking the challenges. So, in the report, they discuss and they basically say that Canada's affordability crisis may be an unintended consequence of record international inflows, layering on top of peak domestic demographic demand, both of which are combining to pressure a construction industry already near full capacity. The catch is that driving down prices will incent less supply, and at the same time, heightened immigration flows designed to ease labor supply pressures immediately add to the housing demand they're trying to meet. The infrastructure in place and the industry's ability to build clearly can't support unchecked levels of demand, so the affordability conundrum continues. So they're basically suggesting that, this booming population that's meant to ease labor markets is putting pressure on the housing market because supply can't keep up. And they had this fantastic chart that basically looked at the price growth, sort of the real house price appreciation relative to the population growth across different countries. And they found a very clear pattern. I mean, the countries like Canada, Australia, New Zealand that have the most booming kind of populations are also seeing the most rapid appreciation in house prices, and countries where house prices or population growth is slow. I mean, Japan and Italy kind of at the lowest end are actually not seeing much growth in home prices. So there's definitely this relationship. And they argue that, a 1% increase in our population growth leads to a 3% increase in house prices. So, if we're at 2%, our population growth, that would be a 6% increase in home prices just for that factor. And the reason, of course, is because it's very hard for the construction sector to keep up with the boom. When we think about how many homes we need, we keep hearing about supply. I mean, Scott Aitchison, who's the housing critic for the Conservatives, basically kind of quoted what the CMHC says, that we need to build 5.8 million homes over the next 7-8 years, and this really translates into 760,000 completions per year when we've never really built more than 250 to 260,000. So their solution, this is the Conservative solution and the Liberal solution to the crisis, is to triple housing completions immediately. And, BMO's economists said, well, while most will argue for a supply side fix, our long-standing view has been that it's wishful thinking to believe that an industry already running at full capacity can simply double output in short order, flood the market with new units, and bring prices and rents down. And they highlight, 3 reasons why. And they say, first, that housing supply can only respond gradually and is essentially fixed in the short run, whereas demand can change in a moment. And what they mean by that is we know what housing supply is going to be over the next, few years, because it takes quite a long period between projects to sort of launch, to have sales, to get permits, to break shovels in the ground, to actually build. So the number of active units under construction. So we can kind of forecast and predict what completions are going to be like over the next 2 or 3 years. It's not an unknown variable because we know how many permits are being issued each year. We know how many shovels or how many starts are happening and how many units are under construction. So supply is pretty fixed in the short term. Second, he argues that even over a more extended period of time, there are clearly limits to how quickly supply can respond, given Canada's existing skilled trade workforce, availability of service, land, and materials. Those are other constraints. And finally, an important one they highlight, which I think is a great one, that any success in improving affordability, i.e. lower prices, will sow the seeds for less building in the future. And we're kind of seeing that now. Right now, housing starts are going to be declining, and not because of gatekeepers or NIMBYs, but it's because prices have declined, investors are not as active, builders don't want to cut their prices. So we're actually going to see less supply during a period where we actually need more of it. So these are going to be the challenges, I think, that are going to be driving, put pressure on Canada's housing affordability over the months ahead. So great report. BMO Economics will include a link in the video and in the show notes for those who are interested. And now what I'm going to do is stop sharing and invite Mr. LaRocque to join us if he is there, to chat about, and unless we have actually, before we go on, I don't know if we have any questions, Urmi. If we don't, we'll just keep going and then we'll wait for questions to come in.
Hi, everyone. We are getting some questions. Maybe, John, one that makes sense to address now is
Sure.
from Zaid Haddad, which follows up on some of the stats and the information you just shared. Can you, help us understand some of the terms you're talking about? And so Zaid asks, am I correct in assuming that months of inventory identifies short-term trends, but housing starts are used to identify long-term trends?
Yeah.
And this pertains to supply.
Yeah, that's a great question. So all the stuff that I'm talking about in those first charts, active listings, new listings, months of inventory, those are real-time metrics about the dynamics that are impacting the market right now, right? It is not, and housing starts, housing completions, all of those, and units under construction are things that will impact our market over the longer term, right? So right now, the fact that there's so little inventory, has to do with other factors other than the long-term supply issue. Like the fact that there's so few homes or detached homes for sale has a big factor, has to do that it's a lot more expensive to upsize now. So if you think about anyone who's selling a $1 or $1.2 million home, well, they would be moving to a $2 million home. And that move to upsize is a lot more expensive because interest rates are a lot higher. So fewer people are upsizing, which means that there are fewer sales and fewer listings hitting the market, right? So there are different factors that impact months of inventory and active listings and all of those variables. But those are, yes, real-time metrics that really give us an idea of what's going on in the market right now. And those can change, obviously, from one month to the next.
Okay, I'm going to just one short follow-up from Zaid. Actually, John, you may need to follow up on this after looking at the numbers. Zaid's asking about what was the highest, well, presumably the highest month of inventory level during the 2008 financial crisis when the market dipped. I don't know if you have that.
I don't have it handy. I don't have it handy, but it wasn't that crazy. I mean, it was, I think even when the market tanked in 2016 in Toronto, I think it hit like 4 or 5, but it was variable. It was very different in different regions. Like if you actually broke it out by house, by low-rise homes and by region, Markham had like 8 months of inventory, something like that, whereas downtown condos had 2. So it's very hard to look at it sometimes at an aggregate level. But I think it was something like 5 months of inventory or 4 months of inventory.
All right, we have some mortgage questions coming in, so let's get to Dave next. I will say that if you want to look at our movesmartly.com report section, you can see some of these months of inventory buildups that John's referencing. We have reports for that year that John mentioned, 2016, and other years as well. Okay, awesome. Let's go on.
All right. Mr. LaRocque, thank you so much again for joining us. We had a rocky, unexpected curveball thrown our way. It looks like, is it last week? Yes, last week, Bank of Canada's announcement. So I think your report did a good job, or your post this week of really unpacking it. So maybe you can unpack what drove the Bank of Canada, to make that move, and and some of the side effects that you've kind of seen, on mortgage rates and fixed mortgage rates.
Sure. Well, it's interesting because we've had this narrative for a while where the Bank of Canada wants to bring inflation down, but the Canadian economy isn't cooperating. A lot of the economic data keep coming in stronger than expected. We had a banner GDP report. It looked like first quarter GDP on an annualized basis was going to come in. StatsCan was saying 2.3. The Bank of Canada was saying 2.5. We ended up at 3.1. We also saw that the early estimate for April from StatsCan showed that GDP was expanding in April. And originally they thought it was slowing because everybody's kind of waiting for the other shoe to drop. All these rate hikes have happened. They kick in with a lag. The question is, why isn't inflation cooling? And the frustration from the Bank of Canada is they don't know whether or not they need to keep hiking or whether what they've done is enough and they just need to wait. So all else being equal, they decided they would pause and allow for some time to go by. But the market, again, wasn't cooperating, or the economy wasn't cooperating. And the challenge the Bank of Canada had was all the economic data is still quite strong. And we have to worry about inflation expectations, because regardless of what might have happened if we left everything the same, if people perceive that there will be higher inflation, if inflation expectations become unanchored, then that will become self-fulfilling prophecy. So it almost matters more now in the current environment, because inflation has been hot for too long, what expectations are, because they can become self-fulfilling prophecy. So I think the challenge the Bank of Canada had was they wanted to wait. They know that we still have elevated savings on household balance sheets. People saved a lot of money during the pandemic, and those high savings rates meant that people had buffers to pay higher prices. Basically, the reason that companies could raise prices is because people could afford to pay more because they had elevated savings that they built up during the pandemic. Those savings are being burnt through. In fact, they're being burnt through quickly, and they don't have to all disappear, because what we're seeing now is credit card rates are going up. All sorts of credit usage stats show that people are relying on credit more. So that suggests that at the lower and middle income levels, people are having to tap into credit more than they were. And that means the savings are being drawn down. Now, you could look at a stat of the overall savings rate, but that overall stat is a bit misleading, because high income earners don't deplete their savings to the same extent, because they have more wealth. So they aren't going to burn. You're not going to see that number drop to zero. In other words, we're not going to see savings revert all the way back, but we need that process to play out. And the Bank of Canada wanted to pause to allow that to happen and allow for rate hikes to exert their impact, because there's a lag. The challenge the Bank of Canada had was when the US banking crisis happened, bond yields plunged. Everybody bought bonds to in a flight to safety, and that drove down the government of Canada bond yields that our fixed mortgage rates are priced on. So the Bank of Canada, while it was pausing and waiting for rate hikes to kick in and for savings to be depleted, had this tailwind hit the real estate market. First of all, the real estate market rallied by more than expected just when the BOC said it was pausing. As soon as Canadians had a line of sight and felt confident were confident that rates weren't going to continue to rise, because they believed the BOC when it said it was pausing, they jumped back into the market. You and I saw this. Activity picked up. Then when the US banking crisis happened, all of a sudden fixed mortgage rates dropped by 0.5%. And that was a big tailwind for the market. And I think, and I said this in my post, I think that was the straw that broke the camel's back. The Bank of Canada said real estate is the most interest rate sensitive part of our market. And the fact that it's picked up again, and when people buy houses, they buy all kinds of other things. So there's all kinds of knock-on effects in the economy that drive more demand. And ultimately, even though the Bank of Canada only raised this week, the bond market, which is forward-looking, had expected BOC rate cuts and Fed rate cuts this fall. I'd said in my blog for as long as it was coming up in conversation that I thought that was a pipe dream and it wouldn't happen. But ultimately, bond yields reflected that. They were priced for that to happen. Interestingly, Tiff Macklem came out at the last BOC meeting and said that he didn't think that was the most likely outcome, which was a polite way of saying it ain't happening, guys, not on my watch. So interestingly, John, even though the Bank of Canada only raised by a quarter point this week, the bond market went from fully pricing out rate cuts to now pricing in rate hikes. And the swing in fixed mortgage rates, which are what everybody's borrowing at today, has been dramatic. I mean, we've seen about a 90 basis point increase in the Government of Canada 5-year bond yield, and fixed mortgage rates are up anywhere from 50 to 75 basis points. So for people who don't understand what a basis point is, that's 0.5% to 0.75% in the span of a few weeks. So basically, I think what the Bank of Canada said is, oh, and by the way, house prices have an outsized influence and impact on inflation expectations. So if you're the bank and you're worried that people are going to expect higher inflation, it's going to become self-fulfilling prophecy. You've got a tailwind coming out of the US that's dropping fixed mortgage rates. And you're worried when the housing market is picking up and gaining momentum that inflation expectations could become unanchored. Basically, you got to raise at that point. And when you do, the big dramatic change isn't so much your quarter point increase, because people aren't borrowing at variable rates these days, or at least much less so. The big increase is the bond market pricing out rate cuts and pricing in hikes, which swings fixed mortgage rates much more dramatically. And now our fixed mortgage rates are basically at or even a little above the peaks that they were at last year. So if you're the BOC, the quarter point cut did its job. I'm not convinced we'll see another hike by the BOC. I'm not even convinced we'll see another hike by the Fed. We can get into that at a different time. But no, the reality is we're in a very different environment quickly. And that is, in my opinion, exactly as the Bank of Canada intended. And I think the housing market was what tipped the balance.
That's interesting. Now, to what extent, you kind of made me think about an article I read maybe a week or so ago on Bloomberg. They had surveyed a bunch of economists, and I think the headline was something like 70% of economists believe that the federal government's spending policies and sort of our booming immigration, like 1 million people per year versus 350, which is normal, is actually partly driving sort of the boom that we're seeing, both the economic boom in GDP and the pressure on the housing market. And I think the point was, it's like the federal government and the Bank of Canada are kind of fighting against each other. You know, Fed's policies are booming the market. Bank of Canada wants to cool the market. And to what extent do you think there's some truth to that, I guess?
Oh, I think there definitely is. I mean, if you're the Bank of Canada, you can't, it's difficult to blame fiscal policy or immigration policy for the fact that there's too much inflation. Those are your bosses you're talking about, your political masters. So you have to be somewhat diplomatic. I think you could certainly argue that it's not clearly all in one direction. For example, wage growth is quite high still, even though we lost 17,000 jobs last month. Average wage growth is still above 5%. High levels of immigration will help with wage growth going forward. So there are some offsets, but I think yes, on a net basis, certainly fiscal policy, but also immigration policy are not helping the Bank of Canada's cause. And insofar as the BOC has to factor those things in, the rest of us have to accept that rates need to be higher as a result of what the federal government's doing.
Yeah. So you mentioned kind of obviously the increase anywhere from 50 to 75 basis points. So what are we looking at in terms of like a typical 3 or 5 year mortgage, which is what people might be looking like? Are they generally now all above 5%?
Yeah. Yeah, anything starting with a 4 is gone. Depending, there's different rates depending on if you're insured or uninsured. Insured rates are in the low 5%, mid 5% range, depending on if you want a 3 or 5 year fixed. Uninsured rates are now in the 5.5 range, and even as high as 6%. There are 3 year fixed rates from very good lenders now that start with a 6. And
you're kidding me. Oh, really?
Yeah, we haven't seen that before. I mean, the thing is, John, the bond market tends to overreact anyway. And I have found in the past 6 to 12 months, the bond market is overreacting even by bond market standards. Like the pendulum really swings in both directions. Bond market does not like a stable yield environment. So it seems like, everybody's over on one side of the ship and it's tilting hard in one direction. We're going to get lots of rate cuts and we're pricing in all sorts of lower rates. And then all of a sudden, everybody runs to the other side of the boat. And now the yields are tilting the other way. So it feels like it's very frenetic and there's a lot of volatility. And quite frankly, I think anybody talking about where rates are headed should be very humble with their forecasts. We should always be humble all the time. But right now, there's so much uncertainty. The bottom line is when people are looking at should I go fixed versus variable term selection, I think the safe middle of the fairway pick right now is still something in the 3-year range based on where 3-year fixed rates compare to shorter term rates. Mm-hmm. We'll see when the dust settles. If you don't have to pay a lot more for a 2-year fixed rate versus a 3-year fixed rate, I think 2-year fixed rates might make a lot of sense. But you combine where rates are at with term premiums, I would want to get past the current volatility because over the short term, there really are a lot of outlier scenarios. We could see more rate hikes because the BOC has to keep inflation expectations anchored, as does the Fed. But we could also hit a wall. One thing that isn't getting talked about, John, is when those savings rates drop, when people run out of that cash buffer that they've had to absorb those price increases, mm-hmm. the situation on the ground could change very quickly. We could see a deflationary environment, a sharp slowdown. And if that happens, then rates could fall quite quickly. And I think the more the BOC and the Fed hike in the short term, the greater the risk of that scenario unfolding becomes.
Interesting. Now, one thing that I've been thinking about in terms of sort of this rate hike, I mean, I think you kind of touched on it that at the start of the year, I think part of the boom we saw in demand from buyers was the expectation that the Bank of Canada was done hiking. And, I think to some extent, these are the buyers that hit pause in the fall. And I think to some extent, people trying to almost get ahead of the Bank of Canada. I mean, I think there is this perception that if they just wait for interest rates to fall or get cut, then the market would explode. So if they buy now, they're almost like buying ahead of any, rebound in prices. I mean, that didn't work out so well because the market accelerated. I mean, maybe it was fine if you bought in January, but I think my point is that I think part of it was the expectations of where rates were going. So I wonder whether you think, we're going to see, and I think we will, a bit of a cool down in demand, partly driven by the fact that rates are so much higher. It's harder to qualify. And maybe because if people think rates are going to stay higher for longer, there's this less urgency and fear that we're going to see this acceleration in prices again. And I don't know if you're seeing signs of that on the ground. Obviously, people reach out to you when they start thinking about buying. So what are your thoughts on that?
Well, nobody's excited about getting a pre-approval at 6%. I can tell you that. And again, it's early days. These rate hikes have just happened, but I don't think there's any question that it'll cool demand, and it might cool it quite materially. I wouldn't be surprised, John, if the market slowed quite a bit. And quite frankly, if it doesn't, I think the BOC is going to keep raising. I think the BOC has our real estate market squarely in its sights right now. That is the most interest rate sensitive part of our economy. It's a large part of our economy relative to the US. The Canadian real estate accounts for a much larger percentage of our GDP. Our household debt levels are very high compared to G7 countries, and by any historical measure, our debt to GDP ratio is quite high. New incremental borrowers are borrowing at a more leveraged level, and that's causing concern. So I think definitely the Bank of Canada and policymakers in general want to see the market slow down. And I think, quite frankly, they were probably surprised that it took a pause and a little bit of a drop in rates to get it feeling like the market was back to its old self. So I think if the market doesn't slow down, I think the BOC will keep hiking, and I think basically one way or another, by hook or by crook, we're in for a bit of a moribund period for real estate. Interestingly, people say to me, well, I want to wait till rates come down before I buy. And people have to remember, if rates did drop, then they wouldn't be paying today's real estate prices, right? You would win on one and you'd win on, because there's a lot of people saying, I'm going to wait till rates drop before I buy. And if all of those people come back into the markets, they'll be borrowing at lower rates, but they'll be paying higher prices.
Yeah, that's a challenge. And I think that's one of the reasons people were, like I said, rushing in earlier. So yeah, it'll be interesting to see the dynamics. I think we're definitely going to see things ease up. We're already starting to feel it on the ground. So I think the next few months will be interesting. Urmi, I don't know if we have any questions.
You asked a lot of the audience questions.
Did we?
Obviously, the biggest questions are about the impact on the market, whether it would slow the real estate market down in the face of these raising rates. You guys have touched on that. Viewers should know that Dave's latest post is also up on movesmartly.com, so he unpacks some of the things he spoke about. I have a question for Dave, because we're so hand in hand with the U.S. Let's talk a little bit about their rate decision, which was to pause, but strongly, yeah, that was yesterday, I think, signaling that more rises are to come. And also, I did want to clarify for viewers, when Dave said there was a US banking crisis, which set off a bit of a drop in our fixed rates earlier this year, you're talking about their latest banking crisis, their Silicon Valley bank failures.
Yes.
So,
not to be
not 2008. Yeah. So
not to be, well, we got a tailwind then too, quite a big one, as a matter of fact. But we get a lot of secondhand smoke blowing up from the US, and this is referring to Silicon Valley Bank, and Credit Suisse Bank went down. That was a European banking, if not failure, banking tremor. So yes, it is not the first time that Canada has benefited because US bond, something has caused U.S. instability has caused U.S. bond yields to drop. Interestingly, when the fight was going on in the U.S. over raising the debt ceiling limit, and the specter of a U.S. default was rising, and again, not many people thought it would actually happen, but it does tend to drive down bond yields because people pile into the safest assets when they're worried about instability risk. And the irony is the risk of the U.S. Defaulting on its debt caused U.S. bond yields to go down, which is, only the world's reserve currency would see that happen. Every other country, it would be like Greece, their bond yields would go through the roof. But because it's the U.S., their bond yields fall, and Canadian bond yields are highly correlated to U.S. bond yields. For all the time that we spend focused on what's happening in Canada, most of the time, at least in calm seas, what happens in the U.S. matters more. Not the case now. The BOC raising, the Canadian bond market swung much more violently than the U.S. bond market has over the near term, but over a longer term time horizon, any graph that compares Government of Canada 5-year bond yields to 5-year U.S. Treasuries would show that they move very closely together in the long term. And Urmi, sorry, go ahead.
And no, the question there is, the U.S. has chosen to pause. Canada went ahead and hiked. What is the U.S. data suggesting? I know in Canada, where it's the house prices, ironically, as you've already mentioned, that has that outsized inflationary impact. In the U.S., what made them pause, and what is likely to come? Why are they saying hikes are likely?
Well, I think the concern that the Fed has is the same as the BOC. They've just undergone the sharpest series of rate hikes in 4 decades, and they want to allow some time to see how that will impact the economy. Interestingly, when they paused, the reason why we're reading headlines saying that they said more rate hikes were likely is because the US Fed uses something called the dot plot, which is basically they ask every member of the Fed on the Fed's open market committee to plot where they think the Fed's funds rate will go. And that dot plot chart shows, there's a bunch of dots with everybody's name beside it. It shows, or sorry, I don't think their names are beside it, but it shows where they think the rates are headed. And the dot plot shows an average of 2 more quarter point increases this year. So that's why people are saying that even though the Fed paused, that it's planning on 2 more rate hikes. What you don't read as much is that the dot plot is a terrible predictor of where the funds rate is actually headed. You might as well close your eyes and throw a dart at a wall, and you'd have about as much chance of getting it right as the Fed dot plot does. So the market, I think, is as it often does, is overreacting to this one piece of information. I think realistically, you have to believe the Fed when it says it's going to evaluate incoming data, and we have to look forward and say, okay, we know we've had a very sharp series of rate hikes. The economy has to slow. The bond yield curve is completely inverted. Basically, the most reliable indicators we have of recession are indicating with a 99% probability that we're going to see a recession. Interestingly, the Fed is actually forecasting a recession in the second half of this year. That might confuse people because if you look at their forecast for 2023, it says that they're expecting 1% growth. But we've already seen more than 1% growth so far in the US. So if we're going to average 1% over the full year, we need to see a slowdown in the second half. And when you consider that and all of the outliers, I think realistically, the odds we actually get 2 more quarter point increases because the dot plot says that's what's coming. I think I understand why, certainly why consumers would read the articles and think that that's likely. But people who know this stuff and watch it closely should be adding that caveat every time they point out what the Fed dot plot is predicting, because its track record is terrible.
All right, and a quick follow-up there, Dave. A headline hit our newspapers today. I think 70% of Canadian economists expect there to be further hikes this year. You mentioned, though, if things tilt too far the other way, we might see rates come down quickly. So is this, again, the same thing that you're suggesting? People are just projecting sentiment based on what they're seeing right now, people including experts. But really, those sentiments can quickly change as the data comes back.
There's no question. Well, first of all, I'm not predicting rate cuts this year. I was pushing back against that notion quite strongly. So I want to be clear. If what I'm saying is the more the Bank of Canada increases now above where it's already at, the more likely that they'll over tighten. And if they over tighten, then we need more rate cuts sooner. And I think, if they were going to happen late in 2024, maybe now they happen mid-year in 2024 kind of thing. That's ultimately what I think the timing will work out to. The economist forecast, economists, I read a lot of economists, and they seem reluctant to predict turning points in a cycle. They tend to project what's happening forward. Now, mind you, I got it wrong too. I didn't think the Bank of Canada was going to raise. I thought they told us rates were going to stay low in 2020, and they had to eat their lunch on that one. They said they were pausing, and that it would take an accumulation of evidence before they came off the sidelines. We'd only had 2 meetings since they paused. So I thought there was enough leeway for them to continue to pause and wait at least until July. In the end, I was wrong. And when I look back and say, well, where did I go wrong? What do I think they saw that I didn't see? I think it was the housing market. And I think it was the fact that they were worried about inflation expectations becoming unmoored. Will they raise again this year? It's hard to say. Guys, we got to remember, it takes 18 to 24 months for a rate hike to exert anything close to its full impact. So if they're worried about inflation not slowing for another 2 or 3 months, a rate hike today doesn't do anything for inflation until well into 2025. So if you're trying to skate where the puck is going, and you're worried that inflation is going to stay hotter than you thought through the summer, to me, rate hikes now that occur with a lag, ultimately, if all you have is a hammer, all the world looks like a nail. So maybe that's the only option they have. But I think they have to be. Well, I know they're carefully considering the fact that what they do now is going to occur with a lag, and that it may well be by the time we get to 2025, the economy looks a lot different than it does today. It should. We've got record high debt levels. We've seen the sharpest series of rate hikes that we've had in 40 years. It's a mystery as to why the economy is as strong as it is. To me, the answer, and you don't read this, a lot of the economists I read still aren't mentioning this as much as I think they should be. It's the pandemic savings. People had a huge buffer that insulated them from the kind of, normally when rates get higher and prices go up, people have less discretionary spending and demand falls, and companies can't have fat spreads because the companies will price it what the market will bear. The market can't bear as much when prices go up and everything gets more expensive. The economy's been able to do that. Consumers have been stronger than expected. The question is why? And to me, when we look at what's different this time versus in a typical the typical reaction to a rate hike cycle, is the pandemic savings. And again, it's not widely reported, but I think we're burning through those savings quickly. And once we burn through those savings, I think our economy is going to start behaving a lot more like we would have expected. And I think it'll be a 180. I don't think it'll be gradual.
That's super interesting. I've actually been wondering the same thing. To what extent are we just feeling, the side effects of these savings and consumption not going down? A lot of people I speak with in different sectors have started saying that they're starting to see spending slow down in discretionary. People in restaurant industries that own multiple, like they're seeing sales turn down. So, and I wonder if we're going to start to see that over the next 6 to 9 months, dragging down the economy a little bit. But I'm gonna sidetrack a little bit to ask you one question we didn't talk about in terms of sort of the impact of these high rates. We chatted a little bit about how it might impact sort of the resale market in the months ahead, say in the next 6 months. One thing that I've been wondering is, how this is going to potentially impact very highly leveraged households, specifically investors who have a lot of properties, because we know that a lot of investors, a lot of condos, whatever, that if they got their rates 2, 3, 4, 5 years ago, and they have these sort of rock bottom amazing fixed payment variable rates, they're not feeling the pressure, right? But the second you have to renew your mortgage, you're going to feel this payment shock for a lot of people. And I do wonder to what extent are we going to start seeing some people just start to deleverage, and start selling, because if you have to renew at 5.5%, it's a lot harder to make those numbers work. And again, I'm not suggesting this is every investor. I mean, if you're an investor, if you own your condo for 10 years, it doesn't matter if you're renewing at 5%, like you're probably cash flowing quite well. But anyone who is closed recently on a new build or bought recently, do you think we might start seeing that? Because kind of going back to kind of some of the things that we talked about a while ago, like the risks to the market and the economy really happen when rates stay high for long. You know what I mean? It's the short-term effect is one thing, but it's actually usually the risks are like, when they stay high for longer, if they're at this level for till the end of next year, what happens? So what do you kind of see sort of those as potential side effects of this higher rate environment?
Yeah, that's a great question, John. I mean, part of the reason why the impacts from rate hikes occur with a lag is, as you say, the average Canadian's got a 5-year term on their mortgage and they have to renew. And until they renew, they're not feeling the hit. There was a recent study done by the Bank of Canada that's getting a lot of play in the media right now, saying that it really won't be until 2025 before the full impact of the rate hikes is felt, because that's when a lot of these variable rate mortgages with payments that were fixed based on variable rates at 1.5% are going to have to be reset at renewal. So if you're the Bank of Canada, you really want to see some rate drop happening before 2025, because if rates are this high, then there's going to be a lot of strain put on borrowers, and the negative impacts will be concerning. So if I'm the BOC and I'm saying, they've said more than once, if we front load the rate hikes, then we'll need fewer of them, and rates can normalize more quickly. So maybe another factor in their deciding to raise last week was, we got to get all of this under control before those renewals kick in 2025, because that's really the point, John, where I think when you're looking at a scenario where the market could be shaken, there's no question the fixed payment variable rate mortgages that were on the books in 2020 are now not remotely representative of where rates are at. Banks are making all kinds of accommodations to borrowers, whether it is allowing them to roll their negative the shortfalls each month into the mortgage, so they're negative amortizing them, allowing people to increase to only cover the cost of the interest payments. There are all kinds of accommodations underway, and OSFI is looking at it too, the banking regulator. In 2025, once you get up to renewal, you gotta reset. You gotta go back to playing by the same rules everyone else plays by. And if we get to that point and rates are where they are now, that would be a tripling of rates, a tripling of interest rates versus where people started out 5 years ago, and very little mortgage principal pay down. Usually on a fixed rate mortgage, if rates go up, you have to pay a higher interest rate, but you're also renewing at a lower mortgage balance. So I'm not as worried about fixed rate borrowers. But to answer your question, that is a big concern, and I think 2025. I think our policymakers are well aware that if things stay the same as they are now and we get to 2025, it could get ugly.
Interesting. Well, we have some time, then we can not worry as much. We go to a year and a half. So
A lot has to happen, John. And for what it's worth, I think rates will drop back down by 2025. I think realistically, that's enough time for the BOC's rate hikes and the Fed rate hikes to kick in. And realistically, if they drop to 3 or 3.5%, then it's a very different conversation.
all righty, Urmi, do we have any final questions before we wrap up for the day?
We do. Thanks, Dave. Some of the other questions on mortgages, I think Dave covered. I also saw a couple of more specific ones. Dave's contact information is at the bottom of this post, so that's in our show notes. Let's leave with two general ones. Dave, you might want to stick around as well for them. One is actually late question from Mr. Potato Head, who just joined. I just want to say the name. Have you noticed a tick up in listings over the past couple of weeks? I think you covered that slightly, John. We're not seeing that big number of uptick in listings. You're alluding to, will we see that?
Yeah, I mean, it is up a little bit. It's gradual. Like I said, months of inventory is gradually trending up. There's some seasonality to all of this, but again, it's not like we're not seeing a flood of listings hit the market. So it's not like this surge in supply, but yeah, it's definitely a little bit higher than in the past.
And as John was saying and talking to Dave about, if that pain continues longer, will we start to see some people deleveraging? That would presumably result in an uptick in listings, but we're not seeing that big jump that we've been tracking for a while. And just a final question from Art Masterpieces. Good afternoon, John. Is it a bad time to sell a duplex now in Toronto, or is the fall a better time to sell to get a good offer? We're not in a particular hurry, also considering spring 2024. Let's leave on a concrete note what to make of all this mess and what a consumer should do.
It's such a hard question. I mean, I don't know, because, like we talked about with Dave, sentiment is changing, right? So yes, the inventory is tight right now. Right now is like a seller's market. It's very hard to predict what the market will look like a year from now, right? Like, especially if rates stay where they are. Like, and I don't think we're going to see a crash, but like, might you see inventory build up, supply slow down in a market that looks more like the fall of 2022, which was sluggish, some places selling for a discount, not a lot of multiple offers. And it's very possible, and maybe a little moderate price decline. So, on the flip side, we could have a crazy market. Like, no one predicted the market would take off in the first half of this year, right? So it's very hard to say. My instinct is, if the decision is between now and the fall, you probably want, I think the fall will probably be a little slower just based on some of the reasons that we talked about. But again, like, if you're listing now, you'd want to list right now, not like end of July, because, as we get closer to the end of summer, buyers hit pause, people get tired, even active buyers, like, stop for 2 months. So I'd either list, kind of right away, or, list in September, I guess. I wouldn't list kind of August. But again, not to say that I think September is gonna be terrible. I think it'll just probably be a little bit more balanced and calm than it is now.
All right. I think that helps. Hopefully that does help all our viewers. It seems like, John and Dave, the key is that these trends are really changing quickly. We use the word volatility a lot, but it seems like it is, we're almost tracking week by week to see what news comes in and what might change sentiment.
Yeah. It's been a roller coaster. If you think over the past year, like Q1 2022 was like an insane bubble. Prices are exploding 30% per year. Then in the span of 4 months, prices tanked. Then the next 6 months, they stayed flat. Then 6 months after, they started surging again. You know what I mean? Like, the past year and a half has been a wild roller coaster of volatility, from like surges to plummeting prices to flat prices. And you think the market's boring, and then they explode again. So it's like, and predicting these turning points is unbelievably hard.
And I suspect, John and Dave, you both think that will continue at least 2025, and that's 2 years out.
What, the volatility? Probably, yeah.
Yes.
I think because of the uncertainty
this need to
with
track
rates,
very closely.
Yeah, again, and I think part of it is we have this population boom, so we have this underlying demand. So it doesn't take a lot to stimulate it, right? It's like in the first half of this year, like we talk about Dave, it's like this expectation that rates hit the top, let's get in and buy a home already. You know what I mean? And you can't predict. And that was largely, as far as I'm concerned, a behavioral shift in the market that drove prices. It wasn't fundamental in the sense that like it wasn't interest rates. Interest rates were unbelievably high, right? But it's people's expectations, people's need for housing, not all behavior. Obviously, we have the boom in population, but again, really hard to predict.
Yeah, Urmi, when you think about it, we've had the biggest spike in inflation we've seen in 4 decades. We have a massive response from policymakers from the pandemic, and then to try to stem some of the side effects thereafter. We've got a war in a part of the world that's affecting commodity prices to an extent we don't typically see, or at least haven't seen in a long time. We've got record levels of immigration that are causing a real change in the supply-demand dynamic in the housing market. I mean, there's a lot of factors right now that are well above historical norms. So when you mix all that together in a blender, you get a lot of volatility, and I think that'll continue for sure.
All right, thank you. Well, I guess that's just a plug for us then. Keep watching Move Smartly. Stay tuned.
All right, everybody. Thank you again for all your questions, for joining. Dave, thanks again for joining us. Urmi, thanks for managing all the questions, and we'll see everybody next month.